Sometimes the aftermath is more devastating than the storm. Christia Freeland. This was the case for the 2008 market crash. Although the crash was bad, what was worse was what happened after and how long it lingered. The aftermath caused many people's investments to crumble, and because of this, many people had to declare bankruptcy. From reading various books and watching various documentaries on the topic, I've gained adequate knowledge to give you a brief synopsis of our flawed economy in 2008. Because of big banks, greedy stockbrokers, and debt-ridden households, the market became overpriced, and after this, it crashed, and everyone's investment returns went along with it. So today, I will talk about the things that caused the market to crash, including big banks, greedy stockbrokers, and debt-ridden households. So on to my first point. Many big banks, because of the large financial upturn that was occurring in the previous few years, started lending loans out to people that were not worthy to have them. So before I start this point, I would like to define two terms. First, subprime mortgage. As Britannica Academic states, a subprime mortgage is a type of home loan extended to individuals with poor, incomplete, and non-existent credit histories. Because there's more risk involved with the banks usually charge a higher interest rate on these loans. The second term I would like to define is leveraging. Leveraging is the act of acquiring money and using it for another purpose in hopes of getting a higher interest rate than the money that was loaned to you. For example, when you put your money into a savings account at a bank, the bank is allowed to lend money to other people in the hopes of getting a higher return on your money. So first, big banks, by lowering requirements, started accepting so many people for loans. Big banks lowered requirements and gave mortgages to people who did not deserve them. The overuse of these mortgages and their widespread securitization was one of the primary factors that triggered this financial crisis in 2008 and caused the Great Recession of 2008 and 2009. Because so many mortgages were being given out, the screening process was lacking. First, the only way they could accept so many members was by lowering their restrictions. With the housing boom that was occurring in these years prior, the restrictions were very lacking, and because of this, they would have no documentation and low documentation loans, which meant that you did not need any screening process to get accepted for a loan. On to the second point, many people bit off more than they could chew when buying houses because they never thought the market would crash. In 1997, the debt-to-income ratio was about 77%, and in 2007 it rose to over 127%. So people were having more debt than their annual income. Secondly, these subprime mortgages that were very risky rose from 8 to 20% of all the mortgages available. Additionally, even though certain people were financially stable, some real estate investors and house flippers were buying extra homes because they thought the real estate market would never crash. Even though they had their first houses paid off, this was extremely risky because once the market crashed, their investments went along with it and they had to declare bankruptcy. As CNN Money states, in late 2009, as the market crashed, foreclosures hit a record high of over 81%. And the third point is the greedy fund managers that also caused this market to crash. First, some fund managers, because the markets were returning so high, and even though they knew the market was overpriced, they kept investing for two reasons. The first reason was if they would not invest in these funds and these risky investments, the people would stop investing with them because they also wanted the returns that the other mutual fund companies were giving them at the time. The second reason is because just because everyone else was doing it, most fund managers thought it would be right as well to do. Because these fund managers kept investing, they were able to charge higher fees and give even riskier investments. First, they gave higher fees because their funds were returning at such a high rate. And secondly, they gave funds such as mortgage-backed securities, which were basically funds that people would invest in, which were a large pool of mortgages. And once the housing market crashed, these mortgages just basically tanked. So today I talked to you about the reasons why the market crashed, including greedy investors, debt-ridden households, and big banks. Although many tragedies were caused from this crash, each and every one of us can learn from this experience and not make the same mistake.